More than half of all S&P 500 options trading now happens in contracts that are born and die on the very same day. In August 2025, that share hit a record. About 62% of all S&P index options volume was in options expiring that day. A decade ago, this barely existed. Today, it is the single biggest force in the index options market. And because these contracts expire at the close, their grip on the market is strongest in the afternoon. These are called 0 days to expiry options, 0 DTE for short. The name is literal. They expire today. Here is the payoff up front. An option's power to move the market underneath it comes from how aggressively dealers have to hedge it. And that hedging pressure is most violent right before expiration, when there is no time left for anything to change except price. Since 0 DTE options expire at the end of today, that pressure piles up into the final hours of trading. That is why so many strange, sharp moves, the sudden afternoon ramp, the late-day reversal, cluster after lunch. You do not have to trade these to feel them. You just have to know they are there. To see why, go back to one idea. Gamma. When you buy an option, a dealer usually takes the other side and then hedges by trading the underlying index, buying as it rises and selling as it falls to stay neutral. How much they must trade for a given move depends on gamma, the rate at which the hedge changes. Now here is the part that matters for same-day options. Gamma is not constant. For an option near the money, gamma gets larger and larger as expiration approaches. Think about why. A contract expiring in a month has plenty of time to drift in or out of the money. So a small wiggle today barely changes the odds. A contract expiring in 2 hours has almost no time left. A tiny move in the index can flip it from worthless to valuable, or the reverse, almost instantly. So its sensitivity explodes. That means dealers hedging same-day options have to rebalance harder and faster for the exact same size of market move. So what does all that concentrated, frantic hedging do to the afternoon? It pulls in two opposite directions, depending on which way dealers are leaning. In the common case where dealers are net long gamma around a heavily traded strike, their hedging fights every move. The index drifts up, they sell. It drifts down, they buy. That mechanical pushback can glue the market to a particular level into the close. Traders call it pinning. The index seems to get magnetized to a round number, and nobody can quite explain why on the news. But if positioning tips the other way, into short gamma, the same machine reverses. Now dealers have to buy as it rises and sell as it falls, adding fuel instead of brakes. A small afternoon dip can snowball into a sharp air pocket, and a small rally into a melt-up, all in the last hour. The crucial point is that because so much of this gamma belongs to contracts dying today, the effect is concentrated in time. It barely matters at the open. By the afternoon, it can dominate. The flow is not reacting to news. It is reacting to the clock. Now the scale, because that is what changed everything. Across 2025, same-day options averaged about 59% of all S&P index options volume, roughly 2.3 million contracts every single day. In the record month, August, it reached about 62%. And this is not only a professional game. By CBOE's own estimates, retail traders made up a little over half of that same-day volume, around 53% in August. So you have an enormous and growing pile of options, more than half of the whole market, all of it expiring within hours, with a huge share traded by individuals on their phones, and dealers hedging against all of it in real time. That combination, size plus zero time to expiry, is exactly what gives same-day options their outsized grip on intraday moves. But here is where an honest channel has to slow down, because the scary version of this story is only half true. It is tempting to say same-day options are a time bomb that will eventually blow up the market. The research is more careful than that. CBOE's own work points out something counterintuitive. Because traders are constantly both buying and selling these contracts, dealers often end up roughly balanced. Their net exposure across all those same-day options can be surprisingly small. And studies so far have not found that the growth of zero DTE trading has caused broad, disruptive market damage. The big effects tend to be intraday and episodic, showing up most when flow is one-sided and liquidity is thin. So the accurate statement is narrow. Same-day options can amplify and concentrate moves inside a single afternoon. That is very different from claiming they are quietly breaking the market. The mechanism is real. The doom is not proven. So the next time the market is dead calm all morning and then lurches in the final hour, you have a sharper question to ask. Not just what was the news, but whose same-day hedges were unwinding into the close. This is a lens, not a signal. It will not tell you which way the afternoon breaks, but it explains why the afternoon, more than the morning, has become the part of the day where market structure, not headlines, is most likely to be steering. The forward question to sit with: if more and more trading keeps compressing into options that expire the same day, does the market's center of gravity keep shifting later and later into the session? More breakdowns of the market's machinery are on the way. This channel explains how markets work. It is educational, and it is not financial advice.